Good morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar. Okay, traders, this video is being filmed on Wednesday night for Thursday's trading. That's 09/24/09. Fed day was Wednesday. No decision, well, no rate hike, no rate lowering. Of course, they can't do it. As expected, Fed did nothing. What happened? Well, there's a swing day sell formation in all of the U.S. indice markets. After the Fed did nothing, the markets ran up, turned around, ran down, and they all put in swing days. Traders, if you don't know what a swing day is, you have a market that's been going up, 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 and then all of a sudden you get a big up day which turns around, goes back down, and settles by the lows. What makes it a swing day is that it went higher than the day before's high, lower than the day before's low, and then settled lower on the day. That gives you a swing day. What you are supposed to do with a sell swing day is the next day when it opens, if it runs up and gets about as high as the day before's high, you sell into that and expect more of a drop, right? Well, I'll tell you what I'm doing about that swing day. I am not taking it. We have been buyers of dips for months on end. It has been working. The last 3 swing days that showed up on the indice charts, do you know what happened, traders? We went down for a half a day and turned around and went straight back up. So I am going to sidestep the sell signal and wait for another buy signal in the indices. Now, because we have been buyers of dips, that mentality has been working really, really well. And because the last few swing days did not produce much of a down move on the next day, I am simply not going to take it. What will I do? Go shopping in other markets, of course. What we will do for tomorrow is we'll wait a half a session and see what develops before we get in. Again, traders, the last 3 swing days in the indices did not produce the down move expected. So much buying has come in that it would send us right back up after a little dip. I'm not willing to sell for a little dip. I'd rather be buying the dips. So again, sidestep the morning session in the S&P and see what happens. With that in mind, we do actually have a trade set up in the S&P, but we're going to leave it on the shelf, see what happens, and I'm not going to take the sell signal. Okay, what I will do is I'll go after sugar because sugar has a well-defined head and shoulders formation. I'd like to show that to you on the charts. I also have noticed a nice wedge in bonds. Bonds look like they want to break out to the upside. Sugar looks like it wants to break out to the downside. The S&P looks like it's going to have another one of those. You think it's going to go lower, it goes down a little and turns around and rallies. But I don't know that's what the S&P will do. Traders, sure, the S&P could turn around today, tonight, and become a bear and just crack. I don't know that that's going to be the case. I do know this. I've been buying dips for a while. It's been working well. I'm going to sidestep the sell signal. I said it again. I'd like for you to take a look at your charts and see if you're very bullish all of a sudden in this market, or if maybe it just had a fluke day yesterday, because we don't trade Fed days for that very reason. That erratic movement, up, down, and then the break to the downside on a day where numbers were pretty bullish, where the market was pretty bullish, where the chart setup was pretty bullish. There goes a Fed day for you, right? The Emini doesn't trade Fed days, and now many of you might have seen why. From what I read in the chat rooms, from what I've seen, the traders who did go out there and trade yesterday, many of you ended up choking on that Fed day. We did warn you the night before, try not to trade Fed days. Okay, back to sugar, back to bonds. I like the bonds for now. If they do break out the upside of that wedge, they should pop a little bit. I like the downside in sugar. Of course, our stops are going to be in because you never know if any trade is actually going to work out for you. So always have your stops in. And with no further ado, let's go to the charts. Okay, traders, what you are looking at is the Dow Jones Industrial Average Daily Bar Chart. And just like that little illustration I drew on the board for you moments ago, look at the outside down swing day that we have. It's an outside day down and a swing day at the same time. As you can see clearly, we went higher than the day before's high, lower than the day before's low and settled by the lows, creating a swing day. What else happened here? It also fell out of this channel for the first time in quite some time. So yes, it looks like it should be a short, right? However, it would only have to drop to about here to find more support again, where I'd prefer to be a buyer than try to sell into that mess. But there is a swing day in the Dow Jones Transportation Average. I'm going to rip right through 3 charts very quickly because swing day in the Transportation Average, as you see, NASDAQ has the exact same swing day, boom, right here. Here's the day before. There is a swing day. It settled lower. Once again, you fell out of the channel. So, yes, looking bearish in the indices, at least for tomorrow. Swing day in the NASDAQ, right? ETF Mini Russell, same thing. Swing day, fell out of love with the channel all of a sudden, turned into a swing day. I am not getting involved. I don't care if it's a swing day. This market goes without me. And why? Because look at this baby right behind here. This is the one we're going after tomorrow. This is the Sugar March 10 daily bar chart. Clearly, there is a head and shoulders well defined. Clearly, yesterday was a massive outside down day, and the market looks like it's probably going to try to move lower again. Traders, this looks like it wants to break down. If this turns out to be an upright head and shoulders with a follow-through, right now it is upright head and shoulders, will it have follow-through? If it does have follow-through, the 1970s is the projection. Sugar is trading around 23.10 as of the settlement on Wednesday. It settled Wednesday at 23.08, 23.10. We could see it hit the 1970s if, in fact, we get follow-through. So we will be taking a short position in the sugar tomorrow. Of course, our buy stops will be in. This is a topping-looking pattern, traders, but the one thing about head and shoulders formations in a bull market is sometimes you move up, you get a head and shoulders formation, you move down a little, and you just continue on. Sometimes a head and shoulder is a continuation pattern. That very well may be what this is, but until it turns into a continuation pattern, we treat it as it is a head and shoulders, and we sell into it. Let's see what happens tomorrow. Of course, our stops will be in because we never trade without them. Again, head and shoulders formation, expecting a down move. If it turns out to be a continuation pattern, so be it. We have a stop in, but we will be handling this from the short side on Thursday. Now, it's not just the formation because behind this we have some indicators, which I'll show you now. Okay, traders, the sugar, I've looked at many, many indicators. All of them seem to be pointing lower. This one seems to be extremely reliable. It is the DMI, or directional movement indicator. When the green, clearly the green is pointing lower and the red is pointing higher, it is a clear sell signal, especially when this indicator agrees with many others. You do have that case. The green is pointing lower, the red is pointing higher, and that looks like a continuation of the downside. I could show you a lot of other indicators on the sugar, but I assure you they all look very bearish. Pull your own indicators on sugar and see if you agree with this. The next trade we will be looking at for tomorrow are the bonds. So let's take a look at the bond chart. Okay, traders, what we are looking at is the bond December daily bar chart. Clearly, you've been in a pretty decent upward channel for quite some time now. And we now have this little wedge within that channel, and it looks like it wants to possibly break out of that wedge. It settled right there at the top of the wedge on Wednesday. So now for trading Thursday into Friday, if we break above the wedge, we have a good side shot of getting to the top of the channel. Let's see what happens there. I hope that's the case. I am going to be buying dips in bonds tomorrow. Of course, stops will be in, as we do with any trade, so that we have a predetermined risk ratio before we ever get in. Of course, we always have a risk-reward ratio. I will say this, because of the volatility in bonds lately, this is going to be a high-risk trade tomorrow. You're going to have to risk almost as much as you're willing to make on the bonds tomorrow. So make sure you do your own homework if you're going to take a bond recommendation. Traders, behind this chart, I have one more chart, and it is an indicator of the bond daily bar. Let's look at that. Okay, traders, you are looking at the CCI, or Commodity Channel Index. It is an indicator that we wrapped around the daily bond bar chart, and it is clearly pointing higher. When you have the blue pointing up like this, it is pointing towards the upside. I assure you of this, just about all the popular indicators that are out there that we use are pointing up right now in bonds. You just seen that wedge on the bar chart. Indicators pointing higher, formation pointing higher. We will be buying a dip in the bond market for tomorrow. Do your own homework, traders. Make sure you pull your indicators, pull your charts. Never accept anyone's recommendations without doing your own homework first and making sure you agree. So, traders, you see those charts? You see we do have a swing day in the indices, traders, but again, I'm not trusting the downside. I don't trust the downside. I trust the upside for now in the indices. So we won't touch that. You see the head and shoulders in sugar. You see the formations agree with more downside. You see the wedge in bonds. You see the formations, or the indicators, I should say, agree with more upside. So let's see what we get. We may actually trade the S&P on Thursday anyway, but not on the onset. Let's let this thing go. We'll collect some data. We'll see what's going to happen. But traders, we certainly love head and shoulders. We love to trade them. We love to trade wedges, and that's what we'll do while we wait for the indices to straighten themselves out. Make sure you pull your charts and do your own homework on that. Traders in the trading contest, good job so far. Very good. Keep it up. Make sure you use your blogs if you are in the trading contest. Fill out your blogs, and we wish you all the best during that contest. All right, traders, I don't have a whole lot to say yet here. I've done a lot of studying. I got a lot in my head. I want to go see it on the channel, on the charts. I want to see it on the computers right now. I'll come back to you tomorrow with another video and tell you what we've come up with. Again, with this S&P, you have no idea how I'd like to be short that swing day, but I'm just not going to do it. We'll see what happens. All right, traders, give me a call anytime there at 702-629-4755. Always, always do your own homework. Always trade with stops. Always keep your emotions out of trading. And one of the best things you can do is to say this to yourselves every morning, every afternoon, every evening. And you know what that is? Stops are in. Emotions are out. Yeah, baby. I hope it helps, traders. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I'm a 27-year seasoned trader on and off the trading floors. This is how I've made my living for many, many years.